Hello friends, today we are going to study about budgeting methods, various methods of budgeting, and that is included in the third chapter of the BPP textbook for ACCA P5. That is what we are considering right now. This topic can also be studied for various other exams, for example F5, that is performance management, or if you are doing any other commerce background course where this topic is included in your syllabus. But for this video, we are referring the BPP textbook for Advanced Performance Management for ACCA. So let's get started. Here is the first point: strengths and weaknesses of alternative budget models. So basically here we are going to study about the different budgeting models that are available, what are their meanings, what exactly is their core function, how are they different from others, and what are its strengths and weaknesses, and based on which they can be used in different types of organizations. So let's read the text. There are a number of different techniques which an organization could use as the basis for preparing its budgets. It is important to assess the potential advantages and disadvantages of each in order to select the one which is appropriate for the organization's circumstances. So as I said, it will depend on what type of organization you have or what type of business you are indulged in, active in, and how the budgeting process, the model that you have selected will be most beneficial to you. So based on the advantages and disadvantages it has, you will select the budgeting model and proceed with it for your organization. So the first one that comes on the list is top down versus bottom up budgeting. So the top down budgeting, it is actually as the name suggests, top down. That means in a hierarchy where there is a which starts with the, let's suppose, managing director, and then you have various directors, then you have the president, vice president, managers, and then the workers. So it is similar to the hierarchy that we had discussed in the previous video, which shows the strategic level, management level, operational level. So the budget is actually made, planned and framed by the strategic people, strategic management, and it is flown through the management and the operational level. That means the budget will be followed by the management and operational level. It is set by whom? By the strategic people, implemented and executed by management and operational level. So the head boss is actually, it's like an instruction, more like an instruction, that this is what we need, as in, let's say, in numbers, and that is what the management level chases after along with operational level. Okay, let's read the text. Budgets are prepared centrally by the senior management. So the word here is senior management. This should help to ensure that the budgets are consistent with the organization's longer term objectives. As we had discussed earlier, strategic level usually looks at the longer term objectives rather than day-to-day activities, and should help to ensure coordination and avoid inconsistencies between the budgets of different departments. So this also helps to actually integrate the budgets of all the departments in the organization. So it's like if you imagine a upside down tree from which it has one root, and then it actually supplements different food items or and water to different parts of the plant or the tree. So similarly, the top management is actually giving instructions as to what each department is supposed to do in terms of budgets, in terms of numbers, and helps the organization move forward. That is, it's kind of uniform, it's kind of consistent. That is the main advantage. So let us just highlight this one. This is to ensure coordination and avoid inconsistencies between the budgets of different departments. However, a significant drawback of top-down budgeting is that local budget holders do not have the opportunity to participate in the budgeting process. Instead, they have the budget imposed on them, which will not improve their motivation to achieve their budget targets. So this is talking about the management and the operational level, that is they don't have any control or they don't have any participation in actually setting the budgets, which means that it's more of like an implementation. It's given to them that this needs to be done instead of taking their own views whether it is achievable, whether it's too simple, or whether it's manageable. Their views are basically not considered because it's like an order rather than a participative approach. Next one comes bottom up budgeting. Local managers prepare their own budgets or at least participate in the budget setting process prior to budgets being reviewed and approved by the senior management. So basically this is being approved by the senior management, and before that the budgets are prepared by the management level itself. So they are preparing their own budgets. Managers should be motivated to achieve their budgets if they have been involved in setting them. So they should be motivated. That's what the point it's trying to make. Well, here we can just write this is the advantage, and the second was is disadvantage. Here, okay, next. Equally, local managers should have better knowledge than the senior management of the conditions of their business units face. As a result, the targets and the information in the resulting budget should be more realistic and achievable. So this is also a plus point, that it will be more realistic and achievable, and they will be more motivated. Now the down point is disadvantage is it could lead to dysfunctional behavior as local managers focus on individual concerns of their business units rather than the corporate objectives. So this is basically the advantage of top down, and the advantage is actually the disadvantage of top down. So you can learn it that way. It's easy. Equally, managers create budgetary slack and set targets which are too easy to achieve. They create budgetary slack. So budgetary slack, just to give what it is, because the word has just come up here, it is the difference between the minimum necessary costs and the costs built into the budget or actually incurred. So this is basically how much money you actually need to incur that expense, and or you can put it versus the cost built into the budget that is allocated for that particular expense. So for example, if I have a particular expense, let's say advertising costs, the minimum cost that I really need to advertise my product is, let's say, $500,000, but in the budget I have taken a margin and I have actually made a bigger amount allocation for the advertising, the same expense, let's say $600,000. So here there is a slack, there is a difference between what actual the expenses, that is 500,000, or what is the minimum expense necessary cost, that is also 500,000. It's just the different terms. And the second one is the actual amount allocation in the budget, which is 600,000. So the difference comes out to be 100,000, and this is the budgetary slack, which mainly mostly what happens is, we'll see again here. Here it comes. Okay, we'll read the text also for the slack. So what happens is that managers, they use this slack for their benefit sometimes, or they waste more money on advertising, which is actually not essential. So the problem here is that they are wasting the resources of the organization, so that they, even if they have taken an extra margin, or maybe this time they had more money, they had allocated more money, but the next time that they get the same amount of money, because if in future their expenses increase, they don't have to really justify a lot to the senior management for that increase. So that's why they tend to waste it this year, so that they can get that amount again next year. This year they waste the slack money so that they can get the higher amount next year. They don't have to give much of explanation. So slack is the difference, okay, this we read. In controlling actual operations, managers must then ensure that spending rises to meet their budget, otherwise they will be blamed for careless budgeting. So here basically it means that when the managers are allocating a higher amount than the previous period in this current year. Okay, so whenever there is a higher amount, they need to justify, they need to give the reasons for why this increase has been, because the approving authority is still the senior management. So still they have to give the reasons. That's what it means here. A typical situation is for a manager to waste money on non-essential expenses so that they use all their budget allowances. The reason behind this action is the fear that unless the allowance is fully spent, it will be reduced in the future period, thus making their job more difficult, as the future reduced budgets will not be easy to attain. Because inefficiency and slack are allowed for in budgets, achieving a budget target means only that the costs have remained within the accepted levels of inefficient spending. One approach to removal of slack is zero-based budgeting. So here they have also introduced another method of budgeting, that is zero-based budgeting. Usually they call it as ZBB, which also will be discussed in this video. Before that, let's just understand this line again. Because inefficiency and slack are allowed in the budgets, achieving a budget target means only that costs have remained within the accepted levels of inefficient spending. That means the slack is actually being spent again on non-essential expenses, so that basically adds on to inefficient spending. So that's what it's trying to say about the slack, that it is the difference between these two amounts and is also the reason why this amount is being spent on inefficient expenses, and why it is an inefficient expenses, because actually it's not required but it is still being incurred by the managers. Okay, next one is incremental. Okay, so here it was the advantages and disadvantages of top down and bottom up are actually just the opposites. And here, when the managers are given the liberty to set their own targets, they tend to set easier targets which are too easy to achieve, as against what the senior management will set the targets. They will be more challenging and little difficult. Maybe sometimes they are able to achieve it or not, things like that. Next is incremental budgeting. So this is the number 2 budgeting model that we are discussing in this video. Incremental budgeting means budgeting which is incremental. Incremental means it increases little by little. It's not a big shock to the budget, but it's a little increment. That is because of the existing market situations, that existing inflation rate, existing interest rates, the small changes in the market which tend to rise the prices, the costs. So based on these things, incremental demand, for example, incremental budgeting is what consists of these factors. Okay, so incremental budgeting is the traditional approach to setting a budget and involves basing next year's budget on current year's results plus an extra amount. So here it is saying that involves basing next year's budget. So next year's budget is on current year's results. So if I am preparing, let's suppose previous year to 20x2, and I have to prepare the budget for 20x3. So here I am going to take the budgets of 20x2 and I am going to add an incremental percentage, which here is an extra amount, that is for the reasons that we have discussed. For example, increase in inflation, there is estimated growth, or there is an estimated increase in the prices of the raw materials, or whatever it is. So there is an increment. So this increment will be added to the numbers of the budget for the year 20x2, that is the current year budget. For the next year we will get that sum. Okay, next, in the process of preparing the budgets, managers might be careful to overestimate the costs so that they will not be blamed in the future for overspending. That's what we also discussed in slack. And this is also the reason for slack, that the managers actually overestimate the costs. They'll take a higher percentage of cost, so that next year even if it is higher, they don't have to worry about explaining the reasons. The personal goals of the managers, personal income, size of staff, esteem and power will often lead to bargained budget, whereby managers intentionally create slack as a protective device. So that's what we have discussed. It's a protective device so that they don't have to give reasons for each and every cost element that is incremental. Going on to the next topic is zero based budgeting. So zero based budgeting involves deconstructing the existing cost base and analyzing the fundamental elements that drive each cost category before preparing the budget for each cost center from the ground up, that is zero base. Every process or expenditure then has to be justified in its entirety in order to be included in the next year's budget. So what is the basic idea? Now zero based budgeting is actually very different from what we have studied, or we will be studying different types of budgeting models. Why is it so? Because nowhere in the budgets they will question the cost. Zero based budgeting is just one. So in this type of budgeting, every cost will be questioned. Every cost element will be asked what is the actual cost expense if we are incurring it right now, right? So it actually deconstructs, or basically if you say in simple words, it actually breaks down each of the major cost elements and sees if it is really necessary for the business, and secondly, how can we get the best price for incurring this expense so that it's not an overload on the cash balance of the organization, right? So here we can just underline it deconstructs the existing cost base. It's actually questioning every single element, every single rupee that is being spent as an expense, and analyzing the fundamental elements that will drive each cost category. Also, if that expense is actually necessary for the organization, and if not, you really don't need to incur it. So that is why it starts from the base of zero, that we actually need that expense to be incurred. If not, then we should not, and if yes, if we need to incur, then what is the best price that we can, or which is the lowest price available to us, and we can go only for that. So this reduces the space for slack, budgetary slack, and it's also based on reasoning for every expense that is incurred, and thus there is no room for estimation, or no room for any what do we say, any extra amount that will get wasted. So this is basically a lean approach, which actually keeps it very clean and simple. Okay, so let's get back to the text. Before preparing the budget for each cost center from the ground up, that is zero base, every process or expenditure is to be justified in its entirety in order to be included into next year's budget. In ZBB, there should be a positive attempt to eliminate inefficiency and slack from the current expenditure, not merely to prevent future cost increases. ZBB rejects the idea that next year's budgeted activity should assume that last year's activity will continue at the same level or volume, and that next year's budget can be based on last year's cost plus an extra amount on the expansion or inflation. So there is no estimation as an incremental incremental budgeting. And also this also needs to justify for the next year the expenses incurred in the current year. That means if you have incurred an expense this year, it doesn't mean that next year also you're going to incur it. You need to give the explanation of why you need to incur the very next year. So it is very challenging at each point of budgeting in ZBB, and therefore the slack is kind of remains very low, almost negligible, and the inefficiencies are definitely being reduced. Personally, I really like ZBB approach rather than the other ones, because you don't really get to question why this is happening, and whereas if you see practically which is the easier one, definitely the other one. ZBB is going to be challenging because everything you need to question and every element you need to check whether you really need it, what are the lowest prices which are available, and things like that. It's nice but it's challenging, and definitely the other ones are quite easier. One of them is rolling budgets, which we are going to study here. So the rolling budget is a budget which is continuously updated by adding a further period. It can be a month or a quarter when the earliest period has expired. So basically, if let's say the year 20x2 has got over, and now for the year 20x3 you need to prepare budgets. You already have the budgets for 20x2, so what you usually do is you actually roll forward it. That means you have the carrying balances of the last year, that is the year 20x2, and then you put them as opening costs, for example, and then that I have taken as an example. Now for 20x3, if you want for 1 month, for a quarter, or even for estimating for half year, let's say, you will have the format from the previous year with the figures obviously carry forwarded. So you will have a blank space for 20x3, and you can put in the figures based on your estimation. For example, if you have to put an increase, a growth rate, or increase due to inflation, so you can adjust them, but you can get the base numbers for the year 20x3. That is what it means by rolling budgets. It's really simple. Rolling budgets are an attempt to prepare targets and plans which are more realistic and certain, because this will be very similar to the last year with certain differences which we are expecting or assuming, such as inflation rates and interest rates, all those things, particularly with regard to the price levels, by shortening the period between preparing budgets. So budgets can take time getting prepared, then getting being approved by the senior management and other authorities. It can be time consuming where you have to check, but based on the last year you can actually take down those figures, and for now just keep moving forward, right? That's rolling. So you can have, in a short period of time, you can actually just have an idea of how it is going to be in the next month or the next quarter, till the time the budget is being prepared. Instead of preparing periodic budget annually for the full budget period, there would be budgets for every 1, 2, 3 or 4 months. Each of these budgets would plan for the next 12 years, so that the current budget is extended by an extra period as the current period ends, hence the name rolling budget. That means it just keeps rolling from one period to another. The budget doesn't realize that the period has got over, but it keeps continuing. That's why the name rolling. Fixed budgets. Fixed budget is one that is not adjusted to the actual volume of output or the level of activity attained in the period. This is the most unrealistic, because the actual level will almost certainly be different from the level of activity originally planned. So why fixed budget is called as unrealistic? Because you can't assume that it's going to be exactly the same way it was previous year. It is this year is definitely going to be different from the previous year, because like in maybe let's say in the traditional way how budget were prepared, how businesses were done, if you consider that environment, definitely you can have one or two reasons for why the same thing could be carried on for years and years. But now in the era of technology changes, which is very very rapid, you really cannot estimate, and certainty is, I think, more certain than what certain is. But in this fast moving world, you cannot fix the budget as it was for the previous year. That's why it is called more unrealistic. Okay, this significantly reduces the value of a fixed budget as a cost control technique, as the actual outputs are different from the budgeted level. Consequently, a fixed budget is more useful as a planning tool than a control tool. Because if you have a fixed budget, obviously there are going to be changes and there will be variances. So rather than a control tool, you can use the fixed budget as a planning tool, as to see that what are the actually as changes that we expect in the future for the next year, right? So we can actually and we can actually figure out what we expect for the next year, and where instead of taking it as a control tool, which will basically show us only the planning variances. Now let's check the flexible budgets. A flexible budget, however, recognizes potential uncertainty in actual output levels. It is designed to adjust cost levels according to changes in the actual levels of activity and output. In effect, a flexible budget can be seen as a series of fixed budgets, one for each different level of activity. Flexible budgets may be used in one of the two ways. Planning. At planning stage, when budgets are set to reduce the effect of uncertainty. For example, suppose that a company sells 10,000 units of output during the year. A master budget, the flexible budget, would be prepared on the basis of this expected volume. However, if the company thinks that their sales would be low as 8,000 or as high as 12,000, it may prepare contingency flexible budgets at volumes of different numbers. Control. Flexible budgets are also used retrospectively at the end of each month, control period, or year to compare actual results achieved with the results that would have been expected if actual circumstances had been known in advance. Flexible budgets are an essential factor in budgetary control and various analysis. So basically what happens with flexible budget is that you have a budget, but you know that the demand, the expectations that you have and what the actual circumstances would be are really uncertain. You cannot think of a number from where only you can think is a range, that okay, my demand would be from this to this range, correct? So flexible budgets are prepared keeping that in mind, that you have an uncertain future. You don't know what would be expected. Unexpected could also arise. It won't be the same as what we had the previous year. That's why flexible budgets are made. Now what happens in this is, for example, you had a normal budget of 10,000 units. That's what is given the example. But if you anticipate that okay, this year the sales is low because of XYZ reason, because of or it is high because of again some other reason, ABC reasons. So you can actually reset the budget, make it according to those levels that you anticipate may be higher or lower, and prepare respect the budget for that amount of demand, let's say, for the respective demands. That means if you have 10,000 units budget as your standard budget, but actually you know that you cannot change the demand, which is only 8,000, so you will actually make a revised budget. That is also the flexible budget. That means your budget can be flexible between the two levels of units. You don't have to stick with 10,000 where the demand is only 8,000. And this is what comes into the planning. Now for the control, when you have let's say your demand has been 8,000 in real. Now what you actually have uh, received, what you have actually attained against the budgets, you will now be compared against the actual, right? The revised budget versus the actual results. So now whatever the differences are coming, that would be used as a control, right? The variances. So this is the flexible budget which you prepare from the standard budget, that will be used for controlling purpose. That will be used for controlling purpose. You get my point? The planning will be for future, control will be comparing with the past results, the actual versus the budgeting. Okay, this is very simple because actually you can't really anticipate how much your sales would be, and in case your sales is up and down, you can actually adjust your budgets, and that's the reason it's called flexible. It's simple. Next is activity based budgeting. This is also very interesting and unique. Why? For the reason that it's not just numbers plus an estimation increase or decrease. It's something beyond that, something more thoughtful, like re-engineering. It's really, it's just new in simple words. Activity based budgeting. Now the organizations now realize that actually their costs are driven by the cost drivers, which are certain activities that they need to perform, and that performing the activity is actually the reason for the expense, because you need money to perform an activity. So that activity is called the cost driver. For example, if you want to sell a product, you need to advertise for it, and if you have 3 products, so which product will need what kind of advertisement will also depend, will vary actually. And also the rate of advertisement for each of the product may vary. For example, if you have a soap, if you have a mobile phone, a smartphone, let's say, and the third one is a furniture, so all these 3 will need different kinds of advertising strategies, and accordingly their pricing would vary. So if you have a bulk of $500,000 advertisement cost, you should actually allocate it into cost drivers. For example, the soap is easiest to sell because everybody needs it, as compared to a smartphone, which is sort of a luxury product, or it is bought not on an everyday basis, and versus a furniture, which is like one time investment for many of the many of the families. But it depends on who are your target customers and so on. Therefore, you have different cost drivers, and accordingly your expenses should be categorized according to the cost driver. Here I assume that the soap will have the least advertisement cost because it's a very fast moving consumer good, whereas on the other hand furniture would really need some efforts. You need to put in the money to advertise it, and therefore it will have high expenses. So in activity based budgeting, what it tries to do is to segregate the cost based on the activity. Let's read the text. Activity based budgeting involves defining the activities that underlie the financial figures in each function, and using the level of activity to decide how much resource should be allocated and how well it is managed, and to explain the variances from the budget. Now this one, just the difference point is that each activity needs to be allocated a budget instead of just advertising as a whole, because each activity is different, right, as we discussed for each of the product. Now here is, they'll also have some variances, that is a similarity with other budgets that we have discussed, that some resources would be allocated, they need to be managed, and whatever the actual result is, they will be compared against and taken out the variances, which will be analyzed further. Now ABB is based on the following principles. It is the activity which drive cost, and the aim is to control the causes, that is the drivers of the cost, rather than the cost themselves. That means here we don't aim to reduce the advertising cost of $500,000. What we aim to reduce is, or what we aim to target, or what we aim to control is the cost driver. For example, if soap is really fast FMCG, it moves really fast, the turnover is very quick, you really, do you really think that you need to advertise for it, or do you really think that how much you are advertising for it, is it like more than enough? Do you can you actually reduce that cost and still be okay with the sales that you are doing? All those things needs to be considered instead of the amount itself, how much is being uh, expend expense, right? Okay, with the result that in the long term cost will be better managed and better understood. This means that long term cost means taking future into consideration, that if it will actually affect the outcomes, right? Not all activities are value adding, and so they must be examined and split up according to the ability to add value. So um, not every activity is a value adding activity. Not every advertisement, every viewer that who views the advertisement for which you are actually paying would actually come up and buy your product. So not all the activities are actually value adding. So you need to understand which is more effective means of advertising. I'm just taking the example. So which is the more effective means of advertising, and you focus on that target group. For example, if your online advertisement is more convenient or more effective instead of newspapers, which are going, no one actually looks into the newspapers, right? Nowadays they are looking at YouTube ads, Google ads, all those things. So this is also a method to actually look at the activity and eliminate the non value adding activities. Most departmental activities are driven by demands and decisions beyond the immediate control of the manager responsible for the department's budget. So it's actually based on demands, so you can actually allocate the amount and go forward instead of just being loosely allocating the resources. So wherever you need it, you allocate it there. It's better even for the managers. And it's easier to explain why the amount is such and such. It's a more logical reason rather than just allocating it to the traditional means. Okay, the D point: traditional financial measures of performance are unable to fulfill the objective of continuous improvement. Sorry. Traditional financial measures of performance are unable to fulfill the objective of continuous improvement. Additional measures which focus on driver of cost, the quality of activities undertaken, the responsiveness to change, and so on are needed. That means you need to shred off the traditional measures of how you run your business, and you need to undertake the measures that are actually more effective and fruitful in the modern scenario of changing world, right, with uncertainties and all of that. So you need to consider all of those things, and you need to integrate that into your business so that it will be more effective for you. If just imagine in today's scenario, if you are considering the traditional advice, which actually makes no sense. For example, if you are putting data entries into the system, which actually any robot can do now, any artificial intelligence technology can do now. So it's kind of replacing. You don't need to put your efforts into non value adding activities, which actually can be done very cheaply and by someone else. Here, let's say I'm considering the robot or the technology. So you need to evolve yourself, you need to evolve the methods by which you are running a business, and thus, as we had discussed, AB budgeting, that is activity based budgeting, and zero based budgeting, they are more suitable for current scenario where you need to reduce your cost because the technology is becoming expensive. That is just for an example that I have mentioned, but there will be other factors also, and also that the traditional system is now obsolete, so you need to move on with the new system. That's it for this video. Let me check if okay, so this was the meaning. In the next video I will put up the strengths and weaknesses of different budget models, which is in continuation, which is a part of what we are studying right now. Okay, so thank you for watching the video. I hope you understood what the concepts are, and please do comment if you have any queries, or if you just want to comment in general, and if you have any sorts of doubts, yeah, don't hesitate to share that, and please do like, share and subscribe. Thank you so much.